Welcome and Happy New Year. I'm Frank Holsteen, Managing Director of Wespath's Investment Management Team, the team that oversees the management of our investment funds. From everyone here at Wespath, we hope you had a relaxing holiday season and a great start to 2024. For most investors, last year ended on a high note, thanks to cooling inflation and a change in tone from the Federal Reserve. Both stocks and bonds moved higher in Q4. In the U.S., the S&P 500 stock market index gained 11.7% to end the year up 26.3%. The Bloomberg U.S. Aggregate Bond Index surged 6.8% to finish more than 5% higher for the year. This strong performance underscored how difficult market forecasting has been lately. Heading into 2023, a majority of Wall Street analysts predicted a down year for the S&P 500. Similarly, many economists expected a U.S. recession that did not end up materializing. We think 2023 provides another powerful lesson on the importance of a long-term view and not overreacting to emotion and uncertainty. There's another great example of that within one of the year's top market storylines, the dominance of the so-called Magnificent Seven. As you may have heard, most of this year's stock market gains were delivered by just a handful of companies. Those Magnificent Seven are Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla. Together, these companies make up close to 28% of the entire S&P 500. In 2023, they delivered about 2/3 of the index's total return. In other words, this was not a good year for diversification. If you weren't concentrated in these 7 stocks, you may have missed out on some returns. But let's recall our lesson on long-term perspectives. History shows a more diversified portfolio tends to do better over a long period of time. One way to check this is to compare a market cap-weighted S&P 500 against an equal-weighted S&P 500. The market cap-weighted index is the typical format, which holds more of the bigger companies like Magnificent Seven. The equal-weighted index holds the same amount of all 500 companies. Over the last 20 years, the equal-weighted index has outperformed by 0.4% on an annualized basis. Over the last 30 years, that gap expands to 0.7%. We can see that 2023 was somewhat of an anomaly, not an indicator of how markets usually work. Whether that anomaly continues into 2024 remains to be seen. Remember, near-term forecasting is very difficult. That said, we can still look to historical norms and averages to get a sense of what markets might do under comparable circumstances. For instance, the Federal Reserve has said it's likely near the end of its interest rate hiking cycle. In recent periods, the end of a rate hiking cycle has been generally good for both stocks and bonds. That's valuable history for all investors. But for those saving and investing over a long period of time, no matter what happens this year, you'll still benefit most from patience and sticking to your plan. You've probably heard the Wespath team talk about maintaining our disciplined approach through different market cycles and uncertainties. We continue to have conviction in that approach right now.